Let me introduce you to John. He is a hardworking man, trying to balance his job, family, and finances. But despite his efforts, his investments are not giving him the returns that he had hoped for. Like many of us, John feels lost with the stock market. The complicated terms and the mixed advice make him feel frustrated and unsure. One day, during a break at work, John finds a post about The Little Book That Still Beats the Market by Joel Greenblatt. The promise of a simpler and better investment strategy catches his eye, and he decides to read it. The book introduces Jake to the magic formula, a simple, rule-based way of investing that promises to time and beat the market. The magic formula is based on two main ideas: high return on capital and good earnings yield. These two things help find undervalued companies that are making good profits. Return on capital, or ROC, shows how well a company uses its money to make profits. A higher ROC means the company is using its resources well. On the other hand, earnings yield shows how much profit a company makes compared to its market value. A high earnings yield means the stock is undervalued and could be a good buy. Excited by the magic formula, Jake decides to use it. He uses an online tool to find stocks that meet the formula's criteria and creates a list of potential investments. With his list ready, Jake builds a diversified portfolio. He organizes his investments in a spreadsheet, tracking how they perform over time. After a few months, Jake checks his portfolio and sees positive returns. The magic formula is working and his confidence grows. He starts seeing investing not as a gamble but as a smart strategy. The magic formula has given Jake a new way to look at investing. With a clear rules-based strategy, he is making better decisions and getting better results. After seeing positive returns from his magic formula portfolio, Jake is eager to dive deeper into the concepts that make this strategy work. One key component that piques his interest is earnings yield. Earnings yield is one of the two main pillars of the magic formula. It measures the profitability of a company relative to its market value. But what does this really mean, and why is it so important? Earnings yield is calculated by dividing a company's earning per share by its market price per share. It's like the interest rate you earn on your fixed deposits, but for stocks. To understand earnings yield better, Jake looks at two different stocks. Stock A has an earnings yield of 10%, while stock B has an earnings yield of 2%. This means for every dollar invested in stock A, Jake earns 10 cents in profit, compared to just 2 cents for stock B. A high earnings yield indicates that a stock is undervalued and potentially more profitable. Companies with high earnings yield are often better investments because they offer more value for the money and have the potential for higher returns. Jake decides to apply this concept to his portfolio. He adds a new column for earnings yield in his spreadsheet and ranks his stocks based on this metric. This helps him identify which stocks offer the best value. By focusing on earnings yield, Jake makes informed decisions about his portfolio. He sells stocks with low earnings yield and buys those with high earnings yield. This approach boosts his confidence and helps him feel more in control of his investments. A few months later, Jake checks his portfolio performance and sees improved returns. The focus of earnings yield has paid off, reinforcing his belief in the magic formula and the book. So basically, earnings yield is a powerful tool that helps investors find undervalued stocks with high profitability. By understanding and applying this concept, Jake has taken another step towards mastering the magic formula and achieving his financial goals. With the success of applying earnings yield, John is excited to dive deeper into the next key concept from the little book that still beats the market. This time, he focuses on the concept of return on capital, or ROC. Return on capital measures how effectively a company uses its capital to generate profits. It is a crucial part of the magic formula, helping investors identify companies that make good use of their resources. Return on capital is calculated by dividing a company's earnings before interest and taxes, which is also called EBIT, by the sum of its net working capital and fixed assets. In simple terms, it shows how well a company is using its money to make more money. To understand ROC better, John looks at two companies. Company A has a return on capital of 20%, while Company B has a return on capital of 5%. This means the first company uses its capital more efficiently to generate higher profits compared to Company B. A high return on capital indicates that a company is efficiently using its resources to generate profits. Companies with higher ROC usually have better potential for sustainable and long-term growth. John decides to apply this concept to his portfolio. He adds a new column for return on capital in his spreadsheet and ranks his stocks based on this metric. This helps him identify which companies are using their resources most effectively. By focusing on the concept of return on capital, John makes informed decisions about his portfolio. He sells stocks with low ROC and buys those with high ROC. This approach further boosts his confidence and sense of control over his investments. A few months later, John checks his portfolio performance and sees improved returns. The focus on return on capital has paid off, reinforcing his belief in the magic formula. So, return on capital is a powerful tool that helps investors find companies making the best use of their resources. John's journey with the magic formula has been enlightening. By focusing on earnings yield and return on capital separately, he has seen positive changes in his portfolio. Now, it's time to learn how to combine these two powerful concepts to achieve even better results. The magic formula works best when earnings yield and return on capital are used together. This combination helps identify stocks that are not only undervalued but also highly profitable and sustainable. Combining these metrics gives a balanced view of a company's financial health. High earnings yield shows that a stock is undervalued, while high return on capital indicates efficient use of resources. Together, they point towards strong investment opportunities. To see how this works in practice, John compares two companies. Company X has a high earnings yield but a low return on capital, while Company Y has high values for both metrics. This comparison helps John understand the importance of balancing both factors for better investment decisions. John decides to create a combined score for earnings yield and return on capital in his spreadsheet. He ranks his stocks based on this new metric, giving him a clearer picture of which companies are the best investments. By focusing on the combined metrics, John makes more informed decisions. He replaces stocks that don't meet the criteria with those that do, further refining his portfolio and boosting his confidence. A few months later, John checks his portfolio and sees even better returns. The combined approach of earnings yield and return on capital has paid off, reinforcing the strength of the magic formula. By understanding and applying this combined approach, John has taken another significant step towards mastering the magic formula and achieving his financial goals. Now that John has successfully combined earnings yield and return on capital to enhance his portfolio, he is ready to explore yet another crucial concept from the book: diversification. Diversification is the practice of spreading your investments across different stocks to minimize risk. By not putting all his eggs in one basket, John can protect his portfolio from unexpected downturns in any single stock. Diversification helps reduce the impact of poor performance by any single investment. Imagine spreading a handful of eggs across multiple baskets. If one basket falls, you still have the others intact. To see the benefits of diversification, Portfolio 1 is concentrated in a few stocks, while Portfolio 2 is spread across many stocks and sectors. In the long run, the second portfolio shows more stable returns, even if some stocks perform badly. John decides to apply diversification to his portfolio. He ensures his investments are spread across different companies and sectors, reducing the risk of any single stock negatively impacting his overall returns. By diversifying his portfolio, John makes informed adjustments. He adds stocks from various sectors and reduces over-concentration in any single area, making his portfolio more robust and secure. A few months later, John checks his portfolio and sees more stable and consistent returns. The plan of diversification has paid off, providing a smoother investment journey with reduced volatility. Diversification is thus a powerful strategy that helps investors across the world manage risk and achieve more stable returns. By understanding and applying this concept, John has taken another important step towards mastering the magic formula and achieving his financial goals. Stay with John as he explores the importance of long-term investing and how it can further enhance his investment strategy in the next part of his journey. John has now successfully diversified his portfolio, reducing risk and stabilizing returns. Now, he is ready to learn the importance of long-term investing. Long-term investing is about holding on to investments for an extended period, allowing them to grow and compound over time. This strategy helps investors ride out short-term market volatility and capitalize on long-term growth. Think of long-term investing like planting a tree. It starts as a small plant, but with time and patience, it grows into a large tree. Similarly, investments need time to mature and deliver significant results. One of the key benefits of long-term investing is the power of compounding. Compounding allows your investment returns to generate their own returns, leading to exponential growth over time. To understand the benefits of long-term investing, John compares two strategies. Strategy A focuses on short-term gains, frequently buying and selling stocks. Strategy B, on the other hand, focuses on long-term growth, holding investments for several years. Over time, strategy B shows much higher returns due to the power of compounding. Historical data shows that despite short-term fluctuations, the stock market has consistently trended upwards over the long term. This reinforces the idea that holding investments for a longer period of time can yield better results. John decides to apply the long-term investing approach to his portfolio. He sets clear long-term goals and commits to holding his investments for several years, allowing them to grow and compound over time. Long-term investing, however, requires discipline, especially during market downturn. John experiences a market dip but stays calm and sticks to his long-term strategy. He reviews his investment plan and remains committed to his goals. One of the emotional benefits of long-term investing is reduced stress. By focusing on long-term goals, John feels more relaxed and less worried about daily market fluctuations. After a year, John checks his portfolio performance and sees positive growth. The long-term approach has paid off, reinforcing his belief in the power of patience and compounding. With this experience, John learns that long-term investing is a powerful strategy that leverages the power of compounding and reduces the emotional stress of market fluctuations. John has successfully applied the principles of the magic formula, diversification, and long-term investing to his portfolio. But there is still one more crucial aspect to master: the psychological edge of investing. Investing is not just about numbers and strategies, it's also about managing emotions. John has now successfully applied the principles of the magic formula, diversification, and long-term investing to his portfolio. But there's one more crucial aspect to master: the psychological edge of investing. Investing is not just about numbers and strategies, it's also about managing emotions. Fear and greed are powerful forces that can lead to poor investment decisions. Fear can cause investors to sell during market downturns, locking in losses and missing out on recoveries. On the other hand, greed can lead to chasing high returns and taking on excessive risk. During a market downturn, John feels the urge to sell his stocks out of fear, but he remembers the principles of long-term investing and the importance of staying disciplined. He decides to hold steady, trusting in his strategy. Discipline and patience are key to managing emotions. John sets up reminders and motivational quotes around his workspace to stay focused on his long-term goals. This helps him remain calm and make rational decisions. John's investment strategy now encompasses all the key concepts from the little book that still beats the market: earnings yield, return on capital, diversification, long-term investing, and psychological discipline. By integrating these principles, John has developed a robust and balanced approach to investing. After a significant period, John checks his portfolio and sees steady and consistent growth. The combinations of these principles has helped him navigate market fluctuations and build a strong, resilient portfolio. By mastering the concepts of the magic formula, diversification, long-term investing, and emotional discipline, John has transformed his investment approach and his life. His journey from a confused investor to a confident one is a testament to the power of these principles. Thank you for joining me on this journey through the little book that still beats the market. I hope you found these concepts to be as helpful as I did. If you enjoyed this video, please give it a thumbs up, share it with others, and subscribe to the channel for more insightful content. Remember, the key to successful investing is understanding the principles, staying disciplined, and being patient. See you in the next video.